Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. For today's session, I'd like to talk about an important but often misunderstood topic in SBA lending: special purpose properties, how they're defined by the SBA, what makes a property special purpose, why valuing one of these properties is not the same as performing a business valuation, and some practical insights for navigating their appraisal process. What is a special purpose property? According to the SBA's standard operating procedure, a special purpose property is defined as a limited market property with a unique physical design, special construction materials, or a layout that restricts its utility to the specific use for which it was built. In plain terms, these properties are built for one specific purpose, and adapting them for other uses is difficult, expensive, or just plain impractical. You've seen them before: hotels, gas stations, bowling alleys, funeral homes, cold storage facilities, even wineries and car washes. All of these are designed with a narrow purpose in mind. The list goes on to include amusement parks, dormitories, golf courses, theaters, even landfills and railroad tracks. These properties often can't be repurposed without significant renovation, if at all. So what sets these properties apart? 3 things. Unique design. Their architecture and layout are tailor-made for one use. Special construction materials. For example, a car wash might have built-in drainage and wash bays that don't work for much else. Restricted utility. It's hard to use the building for anything beyond what it was built for. This means the market for buying and selling these properties is much more limited than for general-use commercial buildings. Now, here's where it gets technical, but important. If a loan involves a special-purpose property, the SBA requires an appraisal by a certified general real property appraiser who has completed at least 4 going concern appraisals of similar properties within the past 36 months. The appraisal must separately allocate the values of land, building, equipment, and intangible assets. This is where we start to draw a line between real estate appraisal and business valuation. Appraising these properties isn't always straightforward. Let me share a few challenges appraisers often face. Limited market data. Finding comparable sales for something like a crematorium or a quarry is tough, which complicates valuation. Specialized expertise. Not every appraiser has the experience to evaluate unique designs accurately. Conversion costs. Estimating what it would cost to repurpose a property for another use can be speculative and affect its value. These challenges make it critical to get the appraisal process right. So how can lenders navigate this process effectively? Here are a few tips. Engage qualified appraisers early. Make sure your appraiser meets SBA requirements and has experience with similar properties. Expect detailed reports. Ask for clear breakdowns of land, building, equipment, and intangible asset values to ensure compliance. Plan for extra time. These appraisals can take longer due to their complexity, so build that into your timeline. It's critical to understand: appraising a special purpose property is not the same as valuing a business. A real estate appraisal looks at the value of the land and physical assets, the property itself. A business valuation considers the financial health of the business, its cash flow, goodwill, customer base, and earning potential. Let me give you an example. A gas station property might be appraised at $900,000. But if the business operating inside that gas station is losing money, the business itself may be worth much less or even nothing at all. So when SBA lenders ask for a valuation, they need to be clear: are we valuing the real estate, the business, or both? Generally speaking, a business valuation would be appropriate when the business, the gas station in the above example, is operating from a leased facility. The buyer is only acquiring the business operations, not the real estate, and will continue to lease the real estate from the property owner. If the buyer is acquiring the business and the real estate, the requirements for a special purpose property outlined in the SOP kick in. Why does this matter? For SBA lenders and borrowers, these distinctions aren't just academic. They impact loan eligibility, collateral, and risk. Misclassifying a special use property or confusing it with a business valuation can lead to delays, poor underwriting, or even non-compliance with SBA policy. Understanding how these properties work and how they should be valued helps ensure that loans are structured correctly and responsibly. Special purpose properties are an essential part of the small business lending landscape, but because of their specialized nature, they come with special rules, special risks, and special valuation requirements. By knowing the difference between a property appraisal and a business valuation, and by navigating the appraisal process thoughtfully, SBA lenders and borrowers make better, clearer decisions and keep the deal on track. Thanks for joining us for this episode of the Valuation Desk. At Highland Global, we bring decades of hands-on experience to every appraisal we deliver. SBA lenders trust us because we understand what's at stake: accurate, credible valuations that withstand scrutiny and support sound lending decisions. With thousands of reports under our belt, we don't just meet expectations, we help set the standard. Our deep knowledge of SBA requirements, valuation principles, and industry-specific nuances makes us the go-to choice for lenders who demand expertise they can rely on. For more information on valuation-related topics, be sure to visit our website, highlandglobal.com. Lenders know, experience matters most.